In this video, guys, we are going to look at the pros and cons of trading some of the more obscure CFDs. Stay tuned for this one. Hey traders, warm welcome to you. So CFD trading, super popular, super effective way of getting exposure to markets that you otherwise wouldn't have. And the beauty of CFDs, of course, is that very often the providers will offer an array of obscure markets. So obviously got the traditional markets like your Dow, your DAX, your FTSE, your NASDAQ, your currencies, some CFDs perhaps in individual stocks. But the benefit is that they offer many brokers will offer CFDs in some obscure markets. Now, I've got a list of some of them here which may be obscure to you, maybe not, maybe you've thought of them, maybe you haven't. This is by no means a definitive list. If I've missed any, stick them in the comment section below, please, to help out others who stumble across this video. But I've got some of the pros and cons of trading some of these obscure markets, because it's not I think it's an interesting topic, because there are some really good arguments for it and there's some arguments against it. So let's have a look at some of the more obscure CFDs. And by the way, not every broker will offer all of these or some of these, but it's there for your consideration anyway. Okay, so we're trading a CFD, we're trading a contract for difference. It's literally a contract which just says, hey, I will pay you the difference between the valuation I buy at and sell at, whether I'm going long or I'm going short. And be sure to subscribe to the channel and check out all the video libraries and the videos we've got in the library, should I say, on CFDs, spread betting, markets. If you like markets, you like trading, this is the channel to be. All right, so let's have a look. So some of those obscure ones, maybe not so obscure. Corn and wheat, you know, we've heard about those. They're quite popular, and actually corn's got a reasonable volume. Wheat less so. Soybeans, we've got the soybean oil, meal, and the actual bean itself. And there's an interesting trade opportunity from that called the soybean crush trade, because when the bean is crushed, it turns into oil and meal, and there's a kind of ratio between those three prices, which can be traded as well. So that might be a unique opportunity. And the beauty, of course, with CFDs being able to go long and go short is that you can kind of adjust and adapt and play little games like this. And of course, trading on leverage and margin, you haven't got so much requirement that you would do under normal circumstances. Although these are all traded, obviously, by the underlying futures contract. We've got cotton, orange juice, super thin orange juice, oats, rough rice, sugar, coffee. There's some of the bigger ones here, cocoa, and lumber. Again, that's a pretty thin one. So what are the advantages? Some of the advantages, of course, are that the unique opportunities. You know, everyone's looking NASDAQ and Dow and FTSE and DAX and crude oil and all these big games, but you know, sometimes you get this unique opportunity specifically in this market where, you know, something is fundamentally affecting the supply or demand. Now, this is very different. I think these kind of commodities are very different to something like a stock like Apple or Tesla. You know, no one has to own Apple. No one has to own Tesla. People buying it because they think it's going to go higher. There's a complete difference to why people would buy, say, cotton. People buy cotton because they're manufacturing clothes and they want to hedge their cotton risk. You know, they're not necessarily buying. Of course, speculators like you and I might be speculating on the direction of it, but it's a far different supply demand. A cotton producer might well be selling cotton because he knows that he wants to lock in that amount before the end of the year, or whatever it may be. So it's a very distinct supply demand kind of effect. And let's say, for example, I don't know, crazy thing that people worked out that cotton was bad for you and no one wanted to have any clothes with cotton anymore. Of course, that's going to affect the price of cotton because purely supply demand situation with this. So I think we get unique opportunities that perhaps we don't get necessarily with companies. Now, I'm not saying it's completely different. Of course, supply demand still applies in any market, but there's a distinct difference there on who's on the other side of the deal. So you also get strong moves. You know, very often if you get something like, I remember years ago we had this kind of bug that was attacking the coffee fruit, because it's a fruit at the time of growing, and you know, that really ripped prices up. So we get sometimes these very strong moves and trends that last for a long period of time, because don't forget, you know, when farmers are making their decision of what they're going to plant and the crop they're going to produce and grow, you know, often that stays in place for a long period of time, and the demand for a certain item, or certain, not necessarily a crop always here, is it, but a certain underlying commodity may well be a theme, that's trend that's going to go on for a long period of time. And supply demand is strict. We've talked about that, and no one's looking at these things. So the point is, guys, as well, is that often there's opportunities that no one's looking at, and they're quite slow to come to fruition, or for the mainstream to see it. I remember specifically this coffee incident. I remember it only because I would get involved in it. I was trading, and it was one of the better trades I've made in these commodities. I very rarely trade these things, but always scanning them for opportunities, because that coffee one was such a good opportunity and a nice trade. And we had a situation where, if you looked at the chart started to move, and if you dug into it, it was because of this pest that was parasite, or whatever it was, a disease that was affecting the coffee market. And of course, that's going to affect the price of coffee and increase the price of coffee, because there's going to be a lot more wastage in the harvest. And also, perfect storm for this was a lot of hedge funds were short on coffee, so there's a bit of fuel to the fire. This took a while to kind of come into the mainstream, if you like, because it's just no one's that interested about it. But of course, once it really started hitting the media, coffee prices going up, oh, it's going to affect your Starbucks coffee price or whatever it was. Of course, that added additional fuel to the fire. And if you were early on the trade and you had some scanning, you were scanning these already and you were positioned in the trade, that just really added an extra bit of a boost to it, and added to the fact that hedge funds were short, added to the fact of the actual supply-demand effect. It became a very nice opportunity. So there are opportunities out there and no one's looking at them, which means you can get a bit of a head start. And I say no one, of course, there's plenty of kind of offices out there that are focused strictly on these and are experts on these, but I mean kind of the mainstream, I mean everyone getting involved in it, which can present opportunity as well. Okay, so some of the cons are, of course, the spread. The spread on these, because they are thin, there's low liquidity, the spread is generally wider with the CFD providers. And also, you're probably not going to be able to trade the size, big size. Now, that could be good or it could be bad. But because it's relatively thin, some of these things, now not always, corn and wheat reasonably thick, soybean reasonably thick, stuff like orange juice, lumber, they're very thin. Cotton as well, very thin. I've got a story that I'll probably tell at some point in the video, so make sure you subscribe, where I got caught out pretty badly trading cotton just because it's so thin. But anyway, the spread ends wide, so it's costing you more. So really, you've got to look for generally a longer term play on this. You're not looking for a day trade, generally speaking. You've got to hold this over a period of days or a period of weeks. You've got gaps, big gaps. If there's some sort of news coming out, you get these gaps, and obviously it's exaggerated by volume and liquidity being low. And you've got these opportunity or downside sometimes for limit moves. So a lot of these commodities, when they move a certain amount, that's it. They won't move anymore in the day, and they get locked. So if you're short and the price moves limit up, then you can't do any buying. You won't allow you to buy any more, and then it might move limit up the next day. We don't see this so much anymore this day and age. It's not to say we won't see it, but you've seen it years ago in some of the storybooks. You see, especially like Reminiscence of a Stock Operator, many traders caught on the wrong side of a limit move. So I think the overall thing here is risk, cost to trade, and the risk involved in it, because there's a big move. So if you're going to kind of consider these, then be very cautious about your risk management. This isn't a video about risk management, but be aware of the volume, of the gap, of the kind of things they can move, and you can look on the chart and see the kind of order of magnitude of moves that can happen in these. But there's some unique opportunities, there's some good strong moves, some strong trading environments sometimes, not always, but sometimes they're really kick into gear. And I think that something that no one's looking at, so it always pays to perhaps have a little bit of your trading plan that maybe once a week or whatever, you just kind of scan through these charts and see if anything interesting happening. If it is, kind of dig in, find out what it's all about, and if it's setting up as part of your strategy, might be an opportunity there, or maybe not. All right, guys, there is the pros and cons of trading obscure CFDs. Take care. Bye-bye.